After the ceasefire between Iran and Israel, things are almost back to normal in West Asia, even though the Israel-Gaza conflict is continuing. Brent crude is back to around $68 levels, and stock markets have responded positively. What are the likely trends going forward? Welcome to Geojit Spotlight. After the ceasefire, there is a risk on in global markets. Indian market is among the best performers. Nifty is at the highest level for 2025. We are only a few hundred points away from the record high of 26,277 reached in September 2024. Going by the present trend and the momentum in the market, supported by sustained liquidity flows, a new record high is likely soon. The concern in the market, however, is the high valuations. Nifty is now trading at about 22 times estimated FY26 earnings. These are high valuations, higher than the long-term average of 18.5 times. The last 10-year average PE is 18.5. However, valuations are not excessive, certainly not in bubble territory, particularly in large caps. Let me explain this. There are two broad views regarding valuations in India. One view is that valuations in India are high and hard to justify. Nifty PE of more than 22 is higher than the PE of America's S&P 500, where the global best companies like the Magnificent Seven are listed. Many investment banks and even brokerages are of the view that a PE of about 22 for an economy which has delivered only a corporate earnings growth of around 5% last year is excessive. Of course, this 5% earnings growth was only for last year. The 3-4 years before that, earnings growth was more than 20%. And for this year, earnings growth is expected to be around 12% or even higher. The other view is that Indian valuations are reasonable. Those who subscribe to this view focus on the long-term growth story of India. According to this view, perspective, Indian GDP will double from the present $4.18 trillion to around $8 trillion by 2032. India's market cap is likely to be around $10 trillion by then, that is by 2032. In other words, the wealth creation that has happened during the last 78 years since independence will happen in the next 8 years or so. From this long-term perspective, the present Indian valuations are reasonable. There are even experts who believe that from this long-term perspective, Indian valuations are cheap. Therefore, what should investors do? Both these schools of thought have some logic in their argument. So the issue is, what should investors do now? Those investors who had invested with some clear financial goals, like children's education, wedding, making lump sum payment for buying a house, buying a car, going on a vacation, etc. If their investment has grown big enough to realize these goals, they can sell, redeem their investment and realize those goals. On the other hand, if your financial goal is long-term wealth creation, your goal is to benefit from the India growth story, remain invested and continue to invest systematically. A very healthy trend of the ongoing rally, I'm talking about the recent rally, couple of days, is that the outperformance of quality large caps, that is the healthy trend. Even though stocks like HDFC Bank, ICICI Bank, Reliance Industries, Bajaj Finance, Bharti Airtel, L&T, etc., all stocks we have strongly recommended. Even though all these stocks have appreciated significantly, there is valuation comfort in these blue chips. Their growth potential and quality of management justifies the high valuations. However, investors have to be careful while choosing the broader market stocks in the mid and small cap segment. Mid caps have delivered good results in the last quarter, Q4 of FY25, but small caps have disappointed. Many stocks in the broader market are trading at fancy valuations with price earning multiples of 50, 60, 70, 80, and even beyond. Some of these stocks may have high growth potential, but the problem is when we buy these stocks at excessive valuations, future returns will be low, even when the companies do well. Remember the famous words of Warren Buffett. I quote, "It is better to buy a wonderful company at a fair price rather than a fair company at a wonderful price." Many fair stocks are now trading at wonderful valuations. Therefore, investors have to exercise caution while chasing stocks in this broader market.